Welcome, everyone. Let's begin. Today, we're diving into a really fascinating and fundamental area of corporate finance. We're going to tackle a question that, on the surface, sounds a bit like a magic trick. How can a company actually reward its owners, the shareholders, without spending a single dollar? It's a critical concept, and understanding it involves looking at two very powerful tools: share dividends and stock splits. So let's start right there with that question. I want you to really think about it. It seems impossible, right? In our everyday lives, payment means cash changes hands. But in the world of corporate finance, the answer is an absolute, unequivocal yes. And the key, the entire secret, is understanding that value and cash are not the same thing. Value can be represented by ownership, and today we're going to explore how companies can strategically reshape that ownership to reward their investors. Okay, so let's start with our first major concept for today, the share dividend. This is one of the most common ways a board of directors can provide a return to investors, not with cash, but with the very thing the investors bought in the first place: equity, a larger piece of the company. So let's be very precise with our definition here. A share dividend is exactly what it sounds like. Instead of getting a cash payment that shows up in your brokerage account, you receive more shares of the company's stock. Now, from the company's perspective, think about why this is such a strategic move. It allows them to provide a tangible return, which keeps investors happy, but it lets them hold on to their cash. And that cash is the lifeblood of the business. It's needed for research and development, for expansion, for paying down debt. So it's a way to reward shareholders without turning off the taps for reinvestment into the company's future. You know, theory is one thing, but in finance and accounting, the numbers are what make it real. So let's ground this concept in a very straightforward, practical example to see how it works. This lays it out perfectly. Let's walk through it. Imagine you're an investor and you own 100 shares of XYZ Corp. The board of directors gets together and declares a 10% share dividend. The math is simple. 10% of your 100 shares is 10. So the company issues you 10 brand new shares. You now own 110 shares. But, and this is the part where some students get tripped up, has your net worth instantly increased? No. The total value of the company hasn't changed. Think of it like a pie. The pie is still the exact same size, but now it's been cut into 110 slices instead of 100. So each individual slice, or each share, is now worth slightly less. The total value of your 110 shares should be exactly the same as the total value of your original 100 shares right before the dividend was paid. You know, that slicing the pie analogy is actually the perfect bridge to our next topic, stock splits. Because if a share dividend is like adding a few extra slices to the pie, a stock split is like taking the entire pie and deciding to cut it into double or even triple the number of slices. So a stock split is a much more dramatic change to the share structure, but it follows the exact same logic. It increases the number of shares, but, and this is the key word, it proportionally reduces the price per share. The most common example is a 2-for-1 split. Let's say you own 50 shares trading at $200 each. Your total investment is $10,000. The company does a 2-for-1 split. Overnight, your account now shows you own 100 shares, but the price of each share is now $100. What's your total investment worth? Still $10,000. So why on earth would a company do this? Well, it's mostly about psychology and accessibility. A stock trading at $100 just feels more affordable to a small retail investor than one trading at $200, even though the underlying value is the same. This can increase trading volume and bring more investors into the fold. And this pizza analogy really drives the point home. It's not creating more pizza, it's just changing how you serve it. A stock split doesn't create wealth out of thin air. It simply repackages the existing ownership value into smaller units. But there's a powerful signal here. Companies don't just split their stock for no reason. It almost always happens after the price has gone up significantly. So when management announces a split, they're often sending a message of confidence. They're implicitly saying, we believe our company will continue to grow and our stock price will rise from this new, lower base. Okay, that's a great question, and it leads us to the other side of this coin. We've talked about what happens when a stock price gets too high, but what if a company has the opposite problem? What if its stock price has fallen so low, say below $1 a share, that it's in danger of being kicked off a major stock exchange like the NASDAQ or the NYSE, which have minimum price requirements? Well, in that case, the company can perform a reverse stock split. As you can see, it's the exact inverse of what we just discussed. The goal is to increase the share price. They do this by reducing the number of shares outstanding. For instance, in a 1-for-10 reverse split, for every 10 shares you own, they get consolidated into one single share. and the price of that new share will be 10 times higher. Again, your total investment value stays the same. But here, the signal to the market is very different. While a reverse split might be necessary to stay listed, it's often seen as a sign of a company in distress. Healthy, growing companies rarely need to do this. All right, now let's shift gears. For all of you future accountants, controllers, and CFOs in the room, this is where the rubber meets the road. These corporate actions aren't just abstract ideas. They have to be recorded properly on the company's financial statements. So let's pull back the curtain and look at how this is done from an accounting perspective, starting with that share dividend. This single sentence is the key to the entire accounting treatment. The whole transaction happens entirely within one section of the balance sheet, shareholders' equity. Now let's break down those terms. Retained earnings is the mountain of profits the company has accumulated over its entire existence, minus any cash dividends it's paid out. Share capital is the money that investors originally paid for their shares. So a share dividend is simply a reclassification of value that the shareholders already own. I think this is a fantastic analogy. Imagine the shareholders' equity section of the balance sheet has two main pockets. The first pocket is retained earnings, which is all the profit the company has earned and kept over the years. The second pocket is share capital, which is the money investors initially put in. All a share dividend does is take some value out of the retained earnings pocket and formally move it over to the share capital pocket. No cash leaves the company. The total value held by the shareholders remains exactly the same. And this table shows you exactly how that journal entry would look. You would debit retained earnings, causing that account to decrease, and you would credit the share capital accounts by the exact same amount, causing them to increase. But look at that bottom line. That's the punchline. Total equity is unchanged. This is the proof, right here in the principles of double entry accounting, that no new value is created. It was simply reallocated from one equity account to another. Okay, so we've gone deep into the mechanics of these actions. We've looked at the accounting entries. Let's pull back up to the 30,000-foot view. Why have we spent all this time on this? What's the big picture takeaway for you as a future business professional? Let's just quickly summarize what we've learned. First, companies have these incredibly useful non-cash tools to reward investors, which helps them preserve capital for growth. Second, both share dividends and stock splits fundamentally alter the structure of ownership, how many shares you have. Third, and this is so important, neither of these actions directly changes the total value of your investment at the moment they occur. And finally, we've seen that these are fundamentally accounting maneuvers that just reshuffle value that's already sitting inside the shareholders' equity section of the balance sheet. If you remember only one thing from our discussion today, please let it be this. These actions are about reshaping existing value, not creating new value. They are powerful tools for signaling, for managing a stock's price, and for capital allocation strategy, but they are not a magic wand. Understanding this distinction is absolutely critical to sound financial analysis. And so I'll leave you with this question to think about. Now that you understand the mechanics, the real work of a financial analyst begins. The what is easy. The why is everything. When you see a company announce a stock split, don't just see the numbers. Ask yourself, what is management trying to tell the market about their confidence in the future? Learning to read those signals is what this is all about. Thank you.